Good day, my name is Dean Crocker. I'm a research analyst with PSG Wealth team, and today I'll be taking you through our latest EA report completed on JP Morgan Chase. So on the 13th of July 2021, JP Morgan released their second quarter results for the full year 21. The executive summary has seen what we can see is the group ready to record strong corporate investment banking income, which is mainly non-interest income in nature, and this was bolstered by a significant provision release. This is really due to a normalisation in economic conditions, thus allowing them to be a little less conservative and release a greater provision. Just in terms of results, so the second quarter 21, the revenue was, however, lower quarter on quarter. If I remember correctly, it was down by 5.5% to 30.5 billion. And this was impacted by lower yields on their interest-bearing assets, as well as fewer principal transactions. In terms of the pre-provision profit, it was also lower, reflecting a lower or weakening underlying performance of the business. They then also incurred a net provision release of 2.3 billion. If I remember correctly, there was about a provision of 3 billion, which was released, but the net impact was about 2.3 on the income statement. Ultimately, the earnings per share declined by almost 17%, and they were lower at $3.78 per share. The group has, however, guided towards an increase in their dividends, and this is much like the rest of the banking sector in the US. They propose 11.1% increase in the dividend from, I think it's $0.9 per share to $1 per share in the third quarter. In terms of our recommendation, we have maintained a neutral recommendation. In terms of valuation, the price to book is trading at a very big premium to its 5-year average. This is a 28.2% premium. It's currently trading at 1.8 times book value. And this is also at a 42% premium to its FactSet peers. Now, this might seem significant, but if you look at the averages, 42% premium to its FactSet peers is actually below what it normally trades at relative to its peers. Now, JP Morgan does attract a higher valuation to the likes of Bank of America and such, and this is due to their significantly higher ROE that they've been able to generate historically. This has really just allowed them to trade at a higher multiple relative to the others. The recommendation does take into light that at the present, the banks have seen a bit of a re-rating in terms of share price. It would appear that they had run a bit harder on the back of a resurgence of the economic conditions and expectations in the US. There also was a slight expectation that the yield curves would start to increase. I mean, the 10-year bond touched about 1.9 at some point, and now it's back to 1.3%. This is resulting in kind of the earnings base generating very low interest income, putting the net interest margin in significant pressure. But as such, the market has had to revise their prices for these companies. So our neutral recommendation is underpinned by that. I must stress that should the yield curve start to turn positive and a lot quicker than one expects, that there might be a re-rating upwards in the share price, and that's probably the greatest risk we have to the recommendation. So let's just run through the event. So as I mentioned, on the 13th of July, they released the results. Net revenue did beat expectations, but it was lower than the first quarter results. Net interest income, it missed expectations. It was also lower than the first quarter. Provision of credit losses, you can see that they started to normalize. So in the first quarter, they released 4.1 billion net provision release. In the second quarter, it's only about 2.2 or 2.3 billion. So what we've seen is there's a normalization in the riskiness of the assets, and particularly in terms of the credit loss ratios across these businesses. In terms of net income, it did beat expectations, pleasingly, really due to kind of the provision release, but it was less than the first quarter results. What I mentioned also just in the Bank of America report is that there's been quite a bit of pressure in terms of liquidity in the market. They have ample liquidity in the market, which means the banks are struggling to really place that liquidity where they can generate significantly higher yields. They also did see a bit of a pullback in terms of the loans, net loans and advances during the COVID period, and rightfully so. I guess, as a bank management, you wouldn't want to be seen as taking too much risk during a pandemic. And this has been a concern because the net loans and advances haven't been able to keep up with the amount of deposits coming to the bank. So we have seen quite a flurry from the banks pushing into fixed income markets. However, what is pleasing in the current results is to see a much greater or stronger improvement in the net loans and advances relative to the deposits. So that bodes well for improving the return on those interest-bearing assets. So just in terms of the on-balance sheet credit loss ratio, you can see that it has improved significantly from 2.27% in the first quarter to 1.87%. So that is definitely starting to normalize. In terms of the stability and strength of the balance sheets, the CET1 ratios are still above 13%. Regulatory minimums are roughly about 9 or 9.5%, so they're doing quite well. In terms of the impacts on the date of release, the results were not favorably met or received. They did decrease by 1.3% relative to the market. What we have seen, however, is that JP Morgan has outperformed the benchmark since our last recommendation, which was in July 2020. If I recall correctly, that recommendation was an overweight, so it was vindicated or justified as such. In terms of year-to-date return, JP Morgan's only up 8.9%. If you look to the right, the two tables are effectively talking to the same metrics. We're referring to the price momentum, the 24-day versus the 55-day. Much like the rest of the banking sector, there is a bit of a sell-off, or shall we say sell-in pressure coming through from the market, and they are no different. So in terms of the assessment of JP Morgan, they continue to be, the standout in terms of corporate investment banking. They have this year are still leading the pack in terms of the I would say probably the amount of revenue generated from transactions in that space, and they really have been the standout. I mean, they've done quite well in that sense, and that I wouldn't call it a moat, but they are definitely the standout performers there. The business has weathered the storm well. They've been able to pay out dividends. Their balance sheet remains very stable. They have excess liquidity. So yes, they're in a well positioned to take advantage of economic resurgence, which everyone expects to come from the US. In terms of the US and the excess liquidity within the market, it has been a bit of a concern. And now there's two factors. One being that, as I mentioned, the banks are sitting on excess liquidity and they have to place that liquidity somewhere in order to generate a return, as that is their business. Now, where do you place liquidity when yields are so low? Well, you take on either greater risk and increase your loans, which we haven't seen, or you invest in interbanking rates, or you go into the equity market. Preferably, you don't want to sit on cash, as the cash drag is quite bad for these entities. So this has been a concern for the banks, and I think you can see it across all of the entire sector, that the return on assets and the return on interest-bearing assets are under significant pressure, and the debt-to-interest margins are really low. In terms of the global market or the US market, the Fed is talking about cutting the quantitative easing and maybe pulling, or I wouldn't say sucking or pulling some of the liquidity out of the market, but just reducing it. This bodes well for future yield curves, which, I think the market has priced in a lot of that into the shares. We have seen a bit of a sell-off in the banks in the last month or so, probably just a re-rating in terms of the banks. That the valuations will reach, so that the price is probably around ahead of the valuations. So in terms of all of that, all indications are that the yield curve should start to increase at some point. At the moment, we are seeing 10-year Treasury yields at 1.3%, and inflation in the US between 4 and 5%. So you have negative yields or negative real returns, which it can't continue forever. If there is reduction in quantitative easing, I can only see that the cost of money would increase. So therefore, there is, indications are, particularly in our mind, that the yield curves will increase at some point. This would appear to have been priced in by the market to a large extent, given that the banks are trading at levels which are above what they have been historically. And thus, we're sitting at a position where presently the banks just seem to be fairly valued, which justifies our neutral recommendation. I did, however, caution, same as the Bank of America report, that should we see a rapid re-rating of those yield curves, that these banks could very well generate a significant amount of return if they start to move into that space and you see those yields increasing rapidly. That's the only caveat attached to the recommendation. So just if you'd like to place some trade, speak to either your financial advisor, or you're more than welcome to speak to the trading desk. Please take note of the disclaimer and have a good day. Thank you.